Thank you so much for coming. This is the Cornell Real Estate Council Dallas chapter. What we aim to do is host kind of monthly events. We will do field trips. Thank you, Cullen, for joining us today.
Thank you for having me. By way of introduction, Cullen Aderhold, born and raised in Dallas. I've been with HFF and JLL going on 18 years now. I'm a generalist, so I work in all product types. I tend to do more commercial than multifamily, but really touch all the asset classes. We value about $200 billion worth of commercial real estate per day. So we're a pretty good proxy for the market and what's going on. This is pure data. So there's very little opinion here. We're kind of reporting what we're seeing, what we're touching, what we're doing. There's a lot of chatter in the market. There's a lot of headlines that we read and that we just factually cannot support, and in fact we believe are not true, right? Retail is losing its institutional status. Real estate for the last decade or so has kind of fallen out of that conversation among institutional capital. Fast forward to today, one of the shinier, or one of the better parts of COVID was that it accelerated the death of retailers that were dying on the vine. And the retailers that emerged out of COVID were stronger for it. If you look at the fundamentals of retail today, across Texas, we're about 95, 96% occupied across just all classes of retail real estate. Even malls are something north of 90% today. We haven't built anything in about 15 years, and the retailers are on offense that have survived. Their work from home is rendering office also non-institutional, but the fundamentals in office are completely overstated, or actually overblown. Like virtually all of the net absorption in DFW has been in buildings that were 15 years and newer. And you've actually had a net negative absorption in anything older than 15 years. The market has woken up to, that's not something you can gloss over. So in my opinion, the conversation in office valuation today starts in the 11 cap range. It's an all cash underwrite. So you've taken an entire sector of the commercial real estate universe, and it's basically gone from a levered business to an unlevered business, and that's a painful adjustment, right? So we're just waiting for the capital markets to catch up. And when it does, a lot of people are going to make a lot of money. When you reach that inflection point where NAV really reaches the spot market, magically the investors don't want their money back anymore, right? Fundraising picks back up. This has played out in every cycle since Odyssey Funds existed.
They've been active, right? They haven't been buying anything yet.
No, they have not been. They've been net sellers for the last. I mean, you can see since Q1 of 2022, when those redemption queues started spiking, that's when they started becoming net sellers. So horrible time to sell. They're like Leonardo DiCaprio dumping an old girlfriend. When that industrial building becomes 15 years old, they got to sell that out because it's not core anymore. When they become a net seller of core real estate, and they're no longer also buying core real estate, it's a double whammy, and core real estate all of a sudden becomes extremely undervalued market-wide. Right. And when they turn the corner, it's the same, it's the reverse of that. So that's one of our huge messages, I think, to our institutional clients is buy core real estate, and in about 4 quarters, you're gonna look like a genius. Would like to sell an office building at a 6.1 cap, or sell an industrial building at a 3.9 cap today. This is the 4th quarter NAVs for these assets, just to show you the lag that we're talking about, right? So you can see the 10-year treasury there. You're talking about 48 months, and it's just starting to show. And I've challenged the research department to kind of project out where they think this would be going forward. So think about BREIT, think about KKR, Invesco, all these Brookfield that have these non-traded REITs. Not a lot to see here except that they've turned the corner and they're actually getting net inflows of capital.
Some major impact your alma mater had on the market.
Look at the top. Japan Post, roughly, 5-6 times the size of CalPERS, and their exposure to commercial real estate is something closer to 1.5%. So to the extent those guys wake up one day and say, I want to be 2% or 3% commercial real estate, we're talking about real needle-moving capital, and that's not just Japan Post, but China, Abu Dhabi, Kuwait, GIC, who actually is pretty active in the U.S. You can see at 7% in various verticals like data centers and otherwise today. So if they're investing in buying something at a 8 cap today, on their math it's going to feel more like a 6 after foreign exchange, or 6.5. Right now, the only category of foreign capital that is investing in 100% dollars is the UK and Australian investors. Everybody else is facing some kind of hedging challenge. So it's a tailwind in the numerator and the denominator, which basically means that in the next few quarters, these Odyssey funds are going to feel double underweight in commercial real estate and have that much more pressure to go deploy and bring those numbers up. So we think they're going to be on offense in the next 4 quarters. No surprise, Texas markets have been great in terms of population growth and job growth. One thing to keep an eye on is affordability. Relative to the United States average, we watch, Austin and DFW are slightly inside of the U.S. average. Houston's a little pricier relative to the U.S., but we're still pretty attractive markets. Institutional investors who used to be exclusively focused on gateway markets have almost universally accepted the southern growth markets in lieu of just big name markets. Going back to 1990, the average of the 10-year Treasury is about 4.25. Today it's somewhere around 4.5%. Where do you think interest rates are going to be 2 years from now? You see the bulk of them think that interest rates, the 10-year Treasury will come in something like 50 to 100 basis points. But that's speculation. Most of the cap rates we're going to see down here are going to be closer to that, core plus, even new vintage stuff, closer to 8 to 10%. If the insurance companies went away, if the private equity funds went away, it wouldn't just completely cripple the market. You can look at the number of deals we're selling, but you can also look at, on any one deal, how many bids are we getting? And how many unique buyers are out there in the market. And so you can kind of see a little bit of an uptick here from 2023 to 2024. Data centers, life sciences, manufactured housing, self-storage, SFR, BTR, all of these asset classes have grown, and institutional investors have increased allocations to all of these. Inflation has eased, but it's still above the target. So if you see industrial has risen in the last 10 years to be roughly 40% of their portfolio, you've seen office fall off a cliff from about a third of their portfolio to sub 20%. And the real thing to watch is retail. So wait a few quarters, 4 or 6 quarters. I think you're going to see the buy side demand pick up tremendously. 2026, late 2025 would be a great time to start putting those in front of some investors or buyers. I think that's to sell today would be, missing that window a little bit.